when they come due, we're required to pay the amount out of escrow that's due. So if we've been collecting $1 a month in your house payment, and all of a sudden that first installment's $1,500, so your taxes are going to be $3,000 a year, we're going to pay $1,500 out of your escrow and create a shortage in your escrow.
Sure.
Then we give you, the borrower, two options. One, you can write a check for that shortage. We'll do an analysis, see how much we need to collect. You can write a check for that shortage and bring it whole, or you can spread that shortage out over the next 12 months in your house payment until it's collected back. The only downside to that is if you can't pay the shortage up front, not only is your payment going to go up for the shortage, it's going to go up for whatever your new taxes are going forward. And that's a big jump for people. So I always say be prepared. Even though you're not going to have taxes right away on new construction, be prepared for that, you know, increase to come.
Absolutely.
Yeah, or at least that shortage, so you don't have such a big jump.
You're aware of it.
Yeah.
Exactly. Yep.
And I was kind of scary. I mean, we hear that a lot for people that move here. I'm like, oh my gosh, you know what, that's kind of odd.
Right.
But it's fun in the beginning because you have a nice low house payment for a while until they do kick in.
Do you think, and that kind of, this is off topic a little bit, but do you think our houses, the cost of living in the houses alone is pretty reasonable nationwide here?
Yeah, I don't know if you saw that, they just did a survey, and like Iowa's the best place to live as far as cost of living. Median income is higher than, I mean, we're like, I think in the top 10, yeah. And it's true, I mean, you get a lot of house for your money. And you know, we have basements, we have things, you know, people come. Yeah, we have yards, good sized yards, so I really do. I think if somebody hasn't bought in the last 5 years, they should. You know, if they're thinking about it, now's the time to move.
Get in there. Interest rates are great. What are they at today?
Well, the 30 years about 4 1/4, 4 3/8. Yeah, right in there.
That's pretty good.
Crazy good. Yeah.
So moving back a little bit, you mentioned the insurance, the PMI, those kind of things. You're saying a lot of words that might seem overwhelming to people.
Yeah.
Do you give like a laundry list of things you need to look for, and
yes,
I need to collect versus what you'll collect, or?
Yep, we usually do exactly that. We give them a list of what we need to get from them, so they're, you know, well aware of what we need. And then we talk to them about homeowners insurance, for example. I mean, your homeowners insurance is going to be through whoever you pick. If you've got your car insurance through State Farm, you're going to call your agent and say, hey, I bought a house, I need to get homeowners insurance on it. And then, of course, PMI stands for private mortgage insurance. If you don't have 20% down, you have to get private mortgage insurance. And so all that insurance does is protect the lender in the event that the borrower defaults. We take care of getting that. It's not something where you can shop rates. It's very standardized. Yep.
And that only lasts until you're in a certain, you've paid so much.
Yes.
Is that right?
Yep. On a conventional loan, the loan balance has to reach 78% of the original value, and it comes off automatically. However, if you feel you have 20% equity prior to that, you can always request to have it taken off. So if you put a lot of extra on your principal, or say you did a huge remodeling and you think your values really has gone up, you can always ask to have that taken off. But they will make you pay for an appraisal, and typically they want PMI on any conventional loan for at least 12 to 24 months. There's not a real written rule about that, but they do want it on there for at least, I would say probably at least 24 months in this market right now. So
feel good.
Yeah.
Gotcha. So I've got pre-approved, I got all my papers in line. Is there any pros to cons, or is it just personal preference if you go new house versus used house, or old house, if you will?
You know, there really isn't. I mean, obviously, finding something new is kind of fun. And, you know, maybe you get to pick out a few things, and, you know, nobody's lived there, nobody's used that shower or the toilet or whatever. You know, those are the pros. You know, you get everything brand new. Yeah, you get to make it your own. And plus not having those taxes right away. You know, obviously the pros of an existing home is, you know, you get in a great neighborhood, established trees, a lot of the decorating, landscaping's done. You know, it's more, you know, hopefully you find something that you just fall in love with. And all those expenses have been taken care of. The other kind of funny thing or interesting thing that people like is when you buy an existing home, because we're 1.5 years in arrears on property taxes in Iowa, when you close on that loan, the seller has to give you this nice, what's called a tax proration credit, because they have to give you a credit for taxes that they owe for, but it technically can't be paid yet because we are so behind. It's tricky. So, you know, if you have $5,000 of taxes a year, you might get $4,000 towards your down payment closing costs.
Well, there you go.
Yeah, I mean, and we can't use that to underwrite you or approve you. It's not really your money. But it's a great surprise at closing. So that kind of, you know, makes people happy.
Bonus.
Yeah. You're like, well, I thought I had to give you this, and you know, it's $4,000 less. You know, so those are the fun things, you know, with buying existing. But there's good and bad of both. Probably if you're going to buy something that's existing, get a home inspection. You know, make sure it's all the mechanicals, everything with the house is in good working order.
So if I'm purchasing a house that's 15, 30 years old, I've got the home inspection, Do you think that there are special insurances you might want to take into account if you've potentially bought a lemon and somebody didn't catch it?
Well, you know, you can ask the seller to pay a home warranty, you
Okay.
know, which those I think are good for about a year. As far as insurances go, I mean, that might be something you might want to talk to your insurance agent about.
Okay.
You know, is there other over and above? You know, obviously now with all the water, you know, they're getting
Yeah.
backup insurance, and you know, if they're putting
Right.
extra sump pumps, you know, those kind of things are, yeah, you definitely want to be aware of. And if there were any deficiencies with that existing home, the seller should disclose it. I mean, if they've had water in the basement, if they've had issues or something's not working, by law, they have to disclose that in
Okay.
that seller disclosure.
So,
So,
I bought the house and now I'm flooded, I can come back potentially on the home
Yeah,
and say, hey,
yeah.
what happened?
yeah, I didn't, you know, does this ever happen? You know,
Right.
so,
That's tricky.
yeah.
What are some tips you have for people that you see that are doing things wrong or coming in unprepared or just the wrong things that they're doing out there?
Well, I think probably the biggest downfall is not being completely upfront, you know, in the beginning,
Mhm.
because you know nobody likes surprises, you
Right.
know, and I just had another lender call me to see if I could help a customer of hers, because she met with this particular gentleman, and he said, no, I've been at this job, and I've been here for a year, and this is what I do. Well, come to find out, he'd been there a year, but he went from being salaried to commission, so he was in the
Yeah.
reverse.
Yeah.
So he had only had a short time of being commissioned. But once you're in commission, they have no way to establish an average. And what happened is he basically said, here's what I make, you know, and wrote it down, said how long he's been there, but did not, he just put in his base salary was this. Well, in reality, you know, he was straight commission. So
Oh.
they had ordered an appraisal, got you know, close to closing, and you know, found out he was straight commission, and the loan couldn't go through. So she called me in a panic and said, you know, is there anything that you can do? Well, you know, unfortunately I couldn't help, just because there were some other issues with that file beyond that. And
Yeah.
so, you know, the more upfront you can be with me is helpful, and even with the realtors too, because those kind of things eliminate, you know, a really stressful situation as you get closer to closing.
You almost feel like you wasted your time a little bit because you did all of this work and now it might not even go through,
Yeah.
and like I think the pre-qualification for the loans itself, then you know what you can do, and the
Right.
realtor can point you in the right direction, and you're being a little more efficient with each other's time.
Definitely. Well, and a lot of times too, you know, you got a seller on the other end, and that seller might be buying another house. I mean, you could have multiple people
Sure.
in line, and that's where it's difficult. You know, it's a tough situation. You know, you want to help everybody you can, but part of that could have been eliminated up front.
Right.
You know, and being prepared and knowing, you know, where you are, and bringing those pay stubs in and saying, oh, well,
Right.
it is commission, it's not base. So
if we've got a couple coming in to get their house, or like my husband and I, we weren't
Mhm.
married at the beginning.
yeah.
So is that more tricky in the process, or you take us as we're married?
Yes, yes. The only situation that doesn't work is in a VA loan, because with a veteran, in order to count that co-borrower's income, they have to be married. So VA loans are kind of a different creature.
Tell me again what VA loan is.
A VA loan would be for anyone that was in the military,
Okay.
either existing or past. You know, if they have their certificate of eligibility, which anybody that served a reasonable amount of time is typically eligible for a VA loan. And they would
Gotcha.
know it if they were, but the benefit of VA is obviously you can borrow 100%. It's
Oh,
a lot
nice.
different, yeah. So, you know, they get to reward those people that served our country, which
That's
is
very nice.
great.
Yeah.
But typically, if you're coming in and you're not married, we're just gonna treat you, you know, like a borrower and a co-borrower.
Okay.
And nothing would change. So we would use the income, we use the credit, we use everything. And there may be instances, I mean, this happens a lot where, you know, one person may have a lot of debt but not as much income, where we end up having to take that person off the loan, because you can get more buying power with just that borrower.
Sure.
And if that happens, and you know you're gonna get married or whatever, you can always, you know, when you get married, you become a spouse, so you're gonna be on title anyway, because that is a common law state, so once you become married, you know, you own it.
So you get the VA loan, and then there's two other kinds of loans,
Yes,
right?
there's FHA, which is basically, it's the most probably lenient,
Mhm.
in terms of, you know, they'll allow for a little, lower credit scores and higher debt ratios, but also they only require 3.5% down, and that can be all gifted money from a family member.
Gotcha.
So it's a great way to finance for first-time home buyers. There is a cap on the mortgage amount of the loan amount, I should say, of $271,050. So basically, you can go FHA and buy up to about $280,000
Okay.
and still be able to go FHA. And then of course, conventional. You know, conventional does have some 3% down programs. There's some restrictions with that, because Some of the PMI companies want the borrower to have some of their own money, even though conventionally you don't necessarily have to, and there's some income restrictions,
Mhm.
but normally you'd have to have at least 5% down of your own money.
Okay.
It can be checking, savings, proceeds. You can borrow against the 401k. That's one thing that's very common now because people are short on proceeds or short on down payment. They're
Mhm.
using their own resources.
Gotcha.
So
you mentioned the credit, you know, if I have a bad credit, but something that's maybe, I don't know if this is the norm much anymore, but this is the way it was in our situation.
Mhm.
My husband, he paid for cash on a lot of things. In
Mhm.
fact, he didn't start earning credit until he was probably 22,
Good for
23.
him.
I know, but it really kind of kicked us in the butt when
Yeah.
it came time to work on the house. So do you work through with that with people? I mean, do you look at the situation as a whole versus...
we do. I mean, and that gets trickier when you have to look at alternative credit or lack of credit because there aren't scores. You know, what usually with FHA, even if there's very minimal credit, you can usually get at least 2 scores.
Gotcha.
Ideally, they want 3. So there are options. The other thing, if it doesn't go FHA and it doesn't go traditional, conventional, or VA, Bankers Trust has products that we can hold here at the bank and service ourselves where we
Nice.
don't have to follow those guidelines. So we can look at alternative credit like rent and insurance and things that,
Consistency.
yeah, gym memberships, you know, things that we know
Gotcha.
you've paid consistently but don't reflect on a credit report. And so we also, what makes us unique, have this other set of products and services available that no one else can provide, you know, where we don't have to follow those. Now, they're not gonna be the 30-year fixed, really super low rates.
Sure, but
They're gonna be, you know, really good arms that are secure and safe arms that somebody can just use to get into this house until they establish credit and need to refinance. So, you know, we always have a backup plan. I always kind of think that's a good niche for Bankers Trust in the market because we have that option for
Very
people.
nice.
Yeah.
so, you know, you kind of mentioned this, and I might get the word stumbled along here,
Mhm.
but if we've got the FHA loan, and then we've created enough credit, and then maybe we're going to refinance.
Mhm.
You know, talk just briefly about what would you suggest as a turning point, or what do you look at in refinancing?
Well, you know, the biggest thing with refinancing, first of all, is making sure that you're gonna recoup your cost. If it costs you $3,000 to refinance and you're gonna move in 2 years, it's probably not worth doing.
Okay.
If you're in an ARM and you know you're gonna stay in this house forever and you wanna get to a fixed rate, then refinancing is definitely gonna be a great option for you. And typically with refinancing, you can roll your cost back in. At Bankers Trust, if you're a past customer, you get a discount on cost.
Nice.
So, you know, we try and make it as best for the customer anyway. But you just, the biggest thing is you gotta make sure you're gonna get your money back. Are you doing it for the right reasons? Are you trying to lower your payment? Are you trying to shorten your term? And I usually walk through all that with people, because sometimes, you know, you sit and talk through it, they may say, well, I'm at 6%, and they're not paying any PMI because when they bought it, their value was there. Well, now the value's less.
Sure.
Now, you know, they might drop a little bit in rate, but they're gonna have PMI, which is gonna jack up that payment, and when you start running numbers, you're like, gosh, is it really worth doing, you know?
You're not going to save how much.
Yeah, and I usually like to put a pencil to all that and make sure it's really worth
Worth
doing.
it.
And maybe if it's not worth doing now, who knows, it might be in a couple years, but kind of see where, you know, where you wanna be and
Sure.
what your goals are to make that, you know, work for you,
So I like it. You're building a relationship with the customer along the way, helping
Mhm.
them out and figuring out what's best for them versus just rolling them out with a loan. Like,
Definitely,
that's
yeah,
the best way to do it.
yep, yeah.
All right. Well, Yvonne, I want to thank you so much for
Thank
joining
you.
us and talking us through the process. And we'll have your information if any of you home buyers out there want to come talk to you, new or otherwise. Of course, they can reach you.
Love to help.
I'll put your email up there and your phone number. And I hope they reach out to you. I like the program that Bankers Trust has here. And again, they're local.
Yes, we would love to help, so.
All right. Thanks again
Yeah,
for joining
thank
us. I
you.
appreciate
Thanks
it.
for having me, I
Have a
appreciate
good
it.
day, guys.
Thank you.
Thanks.